Congratulations, you have registered your business, you are aware of the key taxes that you need to pay. And now you're wondering, how do you pay yourself as a director? What are the proper channels for you to take money from your business? Remember, the money that's in your business belongs to your business. And when you pay yourself, there is a transaction that needs to be accounted for. In this video, we're going to go over the right way to do it and how you can stay compliant with SARS. There are a lot of voices out there that talk about how to get money out of your business tax-free. Here are some of them.
I don't actually understand how billionaires avoid paying taxes. Loans. You keep saying that, but how do you pay the loans back? I don't. What do you do when you run out of money? I get another loan. I don't get it. I think that most people understand at this point that I don't really make a big salary. I own parts of companies. And banks are more than happy to use that as...
It's true. Some high net worth individuals have complicated tax structures between them and their businesses. But remember, for you as an individual, you may not have the same resources to hire tax consultants, accountants, lawyers to comb through tax codes and case law to structure your taxes properly. It will be in your best interest to understand what are the legal requirements and the legal way that your taxes will be handled when you pay yourself. In this video, we're going to cover the 3 basic ways that directors can pay themselves from their businesses. First up is a salary. The simplest way for you to pay yourself as a director from your business is to draw a salary from your business. It is structured in the same way that an employee earns their salary from a business. Ideally, you'd set up a contract between you and your business for the services that you provide to your business. And each month, your business will pay you a salary. The advantage of this method is you will then have a simple tax structure between you and your business. Since it's subject to the standard PAYE rules, your business will deduct the PAYE portion of your salary and pay it over to SARS. It will then pay you your net salary. The advantage is that for your business, it can deduct this from its expenses and reduce the profit within the business, thereby reducing the tax burden on the business. This may be disadvantageous if your tax bracket in your individual capacity is quite high. You may find yourself paying 45% in your personal taxes. There are 2 things to consider if you decide to pay yourself a salary from your business. A reasonable salary paid out from your business is generally accepted as a tax deduction from your business. But an unreasonably high salary can be seen as a way for you to reduce the profits in your business and pay lower taxes through your business. Consider this. If your salary is so high that it creates losses in your business, you may end up reducing your tax burden for this year and for subsequent years. So it's important to get that mix right. You will need to sit with your accountant and make sure that you're paying yourself a reasonable salary according to SARS. The second thing is, for most entrepreneurs, a payslip gives them the security of being able to continue their lives as they usually would. If you're applying to purchase a property or secure a lease, you may be required to provide additional documents if you do not have a payslip. Remember, even if you have a payslip, some institutions will still require that you provide additional documentation, such as management accounts, financial statements, and a letter from your accountant confirming your income. So it's important to understand, if you're looking to get credit, what your requirements will be. The second way to pay yourself is through a dividend. A dividend is a distribution of a company's after-tax profits to its shareholders. So it's important that you are a shareholder, not just a director. The dividend is subject to liquidity and solvency requirements before you pay yourself. So basically, you're saying your company has performed well, you've paid your taxes, the company has paid its taxes, you are now paying yourself from the company's after-tax profits. So in so doing, SARS wants to make sure that you're not going to bankrupt the business. The dividend itself is subject to dividend tax. The company, when it pays you the dividend, will withhold 20% of that dividend and pay that over to SARS. When you receive the 80% in your pocket, that is generally not subject to income tax. So let me give you an example with some rounded up numbers just to give you the idea. Your company makes 1.4 million rand in profit. It then pays taxes of 400,000 rand. The remaining after-tax profit is 1 million rand. You then decide to pay yourself a 1 million rand dividend. That dividend is subject to dividend tax, so your business will withhold 200,000 or 20% and pay that over to SARS. You then receive the remaining 800,000 rand. Remember, the benefit is that you will not pay any additional taxes on that 800,000, generally speaking. But your business will not have this as a deduction in its expenses to lower its tax burden. So it's important that you sit with your accountant and do the calculations to see what's best for you and what's best for your business. The third way you can pay yourself is through a director's loan account. You can take a loan from your business to cover short-term needs and pay the business back over time. Remember, when you started your business, you put some of your personal money into the business. So you may find that the business, being a separate legal entity, owes you money. The transactions between you and your business are recorded in the loan account. So you may find yourself in a situation where you need to cover short-term needs and you can take a loan from your business. If you do that, you need to make sure you charge the correct interest rate and you record these payments. Mishandling of the loan account can lead to complications with SARS. For example, the interest rate on your loan that you owe your business is regulated by SARS. Currently, it sits at about 8.5%. If you do not charge the correct interest rate, SARS may see that as a fringe benefit, a deemed fringe benefit, and you'll be liable to pay taxes on that in your personal capacity. If you continue borrowing from your business and growing the debt that you have with your business, SARS can see that as payments equal to salary payments or dividend payments. Once they become deemed salary or deemed dividends, you are then liable to pay dividend tax, PAYE, penalties, and interest. So it's important that you record board minutes, board resolutions, loan agreements, interest rates, and record the payments over time. The loan account is usually used along with the other methods. Most entrepreneurs are going to use a mix of these three ways: a reasonable basic salary paid out every month, an annual bonus paid out of the company's profits, and you manage the transactions between you and the business through a loan account. Perhaps you borrow from the business from time to time, perhaps you put money into the business from time to time. If you like this video, please leave a like and subscribe so other entrepreneurs just like you can find this content. If you still have questions and you're not sure, feel free to comment in the video, or you can book a free consultation with me and I'll be happy to hear from you. You'll find my information in the description below. Have a great day.